Most investors, they only remember the average return. They hear, the market returns 10% average per year, and imagine a smooth line upwards. Real markets don't work like that. Real investing can mean watching years of your savings disappear and then waiting a long time just to get back where you started. Today, I'm asking a difficult question. What if the S&P 500 people are buying today could lose them lots of money? What if the S&P 500 isn't the same one that created so much wealth in previous decades? What if concentration risk is increasing? What if AI enthusiasm is pushing expectations too far? What if valuation indicators are flashing red if warnings of a future that may be lower? And what if just buy the S&P 500 isn't good advice anymore? You saw the title and you saw the thumbnail. You're either thinking this guy's a moron or you're going to the comment section to put some clown emojis. All I want is 10-15 minutes of your time, and then you'll see why I'm right. To start, I want to tell you a little story about Michael. Michael had a wife named Lucy and one kid. They're a happy little family. It's the early 2000s, and he's in his early 30s. He's been hearing from his friends, TV hosts, and financial experts. The stock market always goes up. The S&P 500 is the safest place to build your wealth. Technology is changing everything. To invest his life savings, he puts $100,000 in the market, and he feels confident. The future looks unstoppable. The market always goes up. Technology is reshaping the world. He invests in companies like Cisco Systems. That's the equivalent of, our Microsoft, our NVIDIA. This was the big company back in the day. Then, reality hits. 10%, 20%, 30%, 40%. The markets fall, they keep falling, and they don't stop. Eventually, it's 50%. Savings of $100,000 gone in a couple years. How can you sleep at night knowing your savings are tied up? You can't provide for your daughter, your wife. Mark is distraught. But his friends say, don't touch it. The market always goes up. A decade goes by, 13 years, till his investment is recovered. His investment into Cisco Systems, the big tech company back in the day, down 90%. It took 2 decades for that company to recover. I know this is a grim story, but the picture I'm painting is the reality I see ourselves in currently. And from now on, I'll explain why. You think S&P 500 is the most diversified ETF. It's 500 companies. Where could you go wrong? Well, it's not quite diversifying that risk as much as you would think. To be clear, there are 500 companies in there, but the weights of the 500 companies are nowhere near equal. You see, the S&P 500 is weighted by market cap. And here's where concentration risk comes in. The top 10 companies in the S&P 500 make up nearly a third. And the top 25 companies make up damn near half. Since the S&P is weighted by market cap, this can create a feedback loop. Big companies rise, their market value grows, which is their market cap. Their index weight increases because their market cap increases. Index funds buy more automatically, and their prices rise further. Critics argue this can amplify momentum. The top are familiar names. You got NVIDIA, Apple, Microsoft, Amazon, Alphabet, which is just Google, Meta. And guess what all these top companies are into right now? They are directly or indirectly connected to AI spending and technology demand. The narrative risk. AI excitement and bubble concerns. History often works like this. A new technology appears, People correctly identify it's important, but expectations become excessive. The internet itself is real. It has changed the world. But the problem in the late 1990s wasn't that the internet was fake. The problem was investors pricing companies as if unlimited growth was guaranteed. The dot-com bubble, what I used in my intro. The narrative, the internet changes everything. Today, AI changes everything. Both are true, maybe true. But the question is, how much future success is already priced in? The internet changed economies. AI may change economies. But investors still lost enormous amounts of money when expectations outran reality. Suppose AI becomes worth trillions. If investors already priced in trillions today, future returns become smaller. People confuse great technology with great investments at today's prices. Those are different questions. My final point on AI is this. Right now, there's enormous amounts of capital going into AI infrastructure, chip companies. AI companies are raising huge amounts of money. But the thing is, where is all this money coming from? Let's say, for a simplified example, let's say Company A buys billions of AI chips. Company B sells those chips. And just because Company A and B are associated, both their stocks are going to go up. Then index funds buy more because the company becomes larger. And then investors see higher prices and pour money into these AI companies. The companies raise more capital, they spend more money, and the cycle continues. What we have right now is we have Meta, OpenAI, NVIDIA, like the four of them, and there's other really big players like Oracle, Palantir, all these guys. Circle jerk, like they're all just spending, giving each other money, and just because they're like that together, their stock prices are going up. Price to earnings ratios. I already covered it in one of my smaller videos on Palantir. But its valuation, during its peak, its PE ratio, 40 times bigger than what it should be. And a lot of the big tech companies and AI companies have similar metrics. Now, to be clear, all the companies I mentioned are great companies. I just don't know about at these prices. And that's why I believe AI investment is circular. Now, let's go over indicators that are flashing red. Historically, been used to estimate future return potential. So, the Shiller PE for the S&P. What this model and metric does is it's a formula to value whether or not the stock market is overvalued with plenty of data. And all it is the S&P 500 price divided by a moving average of earnings over the 10 previous years, adjusted for inflation. So if we take a look, I don't know why the thing at the bottom's all fucked, but you can kind of estimate where it would be crashing and where it would be overvalued. 43, dot-com bubble. 27 in the 08 crisis, and it fell down to 15. And you can see we've risen, chugged along. It was at 43 and 27 before the biggest two stock market crashes of our lifetimes. And guess where we are right now? We're at 39.59. Warren Buffett has an indicator for when the stock market is too overvalued. Now, he's the biggest investor on the planet. He probably has an idea of what he's doing. The indicator is a valuation metric that calculates the total value of publicly traded stocks divided by the country's gross domestic product. It's a popular gauge that shows whether the stock market is overvalued or undervalued relative to the actual economy. So historically, values between 75% and 90% are typically reasonable. Above 120 is when the market is overvalued. And currently, we are at 219%. Warren Buffett himself is sitting on historic amounts of capital. He has $400 trillion parked in US treasuries, and he's sitting in Japanese yen. Ask yourself, if the biggest investor on the planet isn't investing in the stock market, why should you? There's one really big portion left of this video, highlighting one great risk, one great systematic risk to the entire stock market. But I've decided I will leave that for its own video. And that will be about Japan and how they hold a detonator that, if it goes off, presents a systematic risk to the entire stock market. Now, I won't leave you with nothing. I want you to ask yourself very key questions here. The petrodollar is ending. Is it ended? Ask yourself, why does Bitcoin go up every 4 years? Why do banks and governments are accumulating precious metals more than ever? Why is XRP important? And why is the S&P 500 tied? That chart that I always put up, that chart. Why is the S&P 500 tied to the monetary supply like that? And why have wages not kept up? I'll put a brief 1-minute video up that tells you why. Folks, what happens before a new monetary system? Systematic debt, loss of confidence, geopolitical instability, conflict, currency substitution, technological disruptions, failures of sound money. Okay? Do you see what's happening here? Does any of that sound fucking familiar? Okay? Look, open your eyes. Our monetary system is failing right before us. No one can afford anything. And this video is all about the infrastructure that's gonna replace it. Lock in. In the meantime, this video was hard to make. I would appreciate any support I can get. To be clear, obviously the S&P 500, these tech stocks, long-term, are okay investments, are great investments even, obviously. But it'd be a shame and a kick in the butt if I stood here and told you to buy them right now, because I don't believe that way. I do think they are great investments and great companies, but I wouldn't buy them at these current prices. I would wait for a haircut, a trim across the entire market before I put my toes into those investments. Personally, not financial advice. You do what you want to do and research. Please research as much as you can. This is the end of the video. Stay tuned to the softcore part 2 of this video.